Whether you are a technical analyst or fundamental analyst, you are going to need time management between managing your investment, work, family, and other activities. We used to find it difficult to balance between them. Technical traders will depend on the time to sell or buy a stock. Fundamentalist will depend on time to value a company for an investment over a long time of period. The saying that time is money is true. But how can you manage between time and your investment if there are so many distracting factors out there? That's why uPort is going to be your stock portfolio assistant to help you balance between time and your investment. What is uPort? Welcome to uPort. uPort is a website for managing and optimizing your stock portfolio. Investors can choose their own optimization between minimum risk and maximum return. Using uPort algorithms, investors can manage their portfolio's current value, gain or loss, number of shares, weight, expected return, expected risk, and more by giving certain constraints. There are 7 steps you need to do. First, name your portfolio. Second, choose your optimization, whether it is a minimum risk or maximum return. Your portfolio will show the current date and time. After that, you need to fill some information. Your stock ticker or symbol, the date when you bought it, and how much you bought it. Now, let's get into the interesting part. You can input how much weight of each stock that you want and also input other constraints such as your budget. Depend on your optimization, you can choose whether to minimize or maximize your expected return or risk. At last, click Solve and you will have your solution. This is how uPort website looks like. First, you have to sign up to create your portfolio. uPort system is very secured. You don't have to worry your information get leaks. To sign up, click on the Sign Up button, fill in your name, username, password, date of birth, CAPTCHA code, and upload your photo. You need to agree to uPort terms and conditions before you can proceed. When you are done, click Sign Me Up. Then, you will receive a confirmation email. After you log in, your next step is to create your portfolio. Input your portfolio's title, stock symbol, the date when you bought the stocks, and volume. If you don't input the volume, uPort will set the volume as 100 by default. When you click the date, uPort system will connect to our database and show you the last price of stock during the day. Click Done, and on to the next step. Fill in your weight and budget constraint. If you choose maximum return as your optimization, the system will automatically close the constraint option for expected return. Instead, you can input your expected risk. Click Solve, and the system will begin calculating. This is what your portfolio is going to look like. Make sure that the result of uPort calculation is right the way you want it to be. Click Yes, and you will be directed to your page. Your portfolio is ready. Even better, uPort now offers premium service. Premium users are right for you who are fundamental investors. You will be able to gain financial information about the company such as PE ratio, price to book value, earnings per share, price per sales, market capitalization, and more. Premium users are also great for you who are technical investors, providing investors with charts such as weight chart, gain or loss chart, and more. Another advantage is that you can save your portfolio scenario, so, in case of emergency situation, you will have a backup plan. Not just that, premium users can personalize their portfolio appearance. And most importantly, work offline by exporting your data to Microsoft Excel. Let me show you the example.
Click Export to Excel and click OK. And wait until the program is open. So this is what the login page looks like. And this is my portfolio. These are the company names, the stock symbol, and they are all from different sectors. This is the date when I bought the stocks, which were in December 2014. And these are the volume or number of shares, the initial price and initial cost. The initial costs are calculated by multiplying the volume with the initial price, while the current value are calculated by multiplying the volume with the current price. The gain or loss are calculated by subtracting the current value with the initial cost. And here are the expected return and expected risk. The average returns comes from the monthly return from 2011 until 2014. And the risk comes from the standard deviation of the return. And these are the portfolio weight. Below the notes are the box plot chart representing the stock's prices monthly from 2011 until 2014. If you want to change the current price, you can click on it and you will be directed to the web query page. Drag the price, right-click and choose Refresh. The new price will be downloaded from the website. So now you have your updated price. You can copy it to your portfolio and you will have your new current value and gain or loss. So let's say that after seeing this, you want to change your portfolio weight. First, what you need to do is make sure that your volume back to default. After that, you can go to Data and click Solver. You can get Solver from the Excel add-ins. So here's my objective, which is maximum return by changing volume, and these are the constraints. So for example, I want to delete this constraint and I want to make AALI less than 10%. And then I want to make TBIG less than 30%. And then click Solve. Solver found a solution, click OK, and you will have your new current value and gain or loss. The new current value is bigger than the previous one, and you will have your new portfolio weight.
Other than this, premium users can see the stock's correlation, beta analysis, confidence interval, linear regression, and our newest feature, hypothesis test.
These are the correlations, beta, and confidence interval of the stock's monthly return from 2011 until 2014. These are the returns and these are the correlations. You can see here that the correlations are mostly positive. Although all of them are categorized as low correlation, the highest correlation is between BBRI and WIKA, while the most negative correlation is between ICBP and AALI. It means that the stocks probably move in opposite direction. Next is the beta. AALI is the least volatile than the market index, while WIKA is 83.7% more volatile than the market index. These are the confidence interval of the stock's average population return. For example, let's say that I'm 95% confident that PTBA stock will have an average population return between negative 3.224% and 2.202%. After knowing this, I can decide whether to sell my shares or not. These are the linear regressions. From the result, I look at the intercepts, coefficients, and p-value of the index towards the stock. From the results, this is the linear regression equation. From the equation, I can predict the return using given index or stock return. By looking at the p-value, I can figure out whether I can predict them or not. For example, ICBP's p-value is lower than 0.05, which means that the index has a significant effect to ICBP's return. While in BBRI's case, the p-value is above 0.05, so the index does not have a significant effect to BBRI's return. In other words, BBRI's return cannot be predicted using linear regression. These are the hypothesis tests. The purpose of this test is to verify the given average population using the z-table. As a result, some of the null hypotheses are accepted and some of the alternative hypotheses are accepted.
uPort will also provide you with several notes and recommendations from our consultants, certified analyst, and portfolio manager. uPort website is updated and maintained daily. Our professional staff also will keep you updated with the latest news. If you have any problems, feel free to contact our 24 hours customers care. That's it. Use uPort and you can manage your portfolio while doing other things and relax. uPort are so simple and so easy to use. Visit uPort at www.uport.com and sign up now. Introducing uPort Mobile. uPort Mobile will help investors keep in touch with the latest price and gain or loss. Using the settings, the app will alert you if the price goes down or up more than you want it to be. After you do the action, whether selling or buying the stock, you can renew your portfolio weight on our website or offline. Now available in App Store and Google Play, uPort Mobile, managing your asset at your fingertips. The idea of creating a portfolio optimizer begins in short semester finance research from January to March 2015, called Portfolio Selection Using Matrix Algebra. However, the research is not yet finished. Out of curiosity, uPort team managed to continue making the Portfolio for Business Statistics final project. Here are the working procedures. First, the team took a look at stocks listed in the Indonesian Stock Index. Second, they chose 25 stocks that was in the LQ45 index from January to July period. Third, they divided the stocks in LQ45 into 3 categories: large, medium, and small market cap. They used the average of the 25 stock as the determinant. Fourth, they chose 6 stocks which company produced product that they are familiar with. The stocks had to have monthly historical prices from 2011 until 2014. The stocks also had to come from different sectors and market capitalization. Fifth, each of the team members chose one optimization and create their mathematical models. Then, they had to present the data in box plot and pie chart. Sixth, they started to create the portfolio model. After trial and error, and having consultations, they made improvement. Seventh, they were required to input more elements to the portfolio. After that, they had to do trial and errors again, and consultation. As the result, they made a better improvement. Eighth, They present their portfolio project and simulation through this video.
These are the mathematical model for my portfolio. I'm using maximum return as my optimization. The coefficients from the Pmax formula are from the average return. The constraints are my budget is less or equal to 1 billion IDR. My expected risk is less or equal to 9%. The coefficients shown in the expected risk formula are from the standard deviation of the stock's return. The weight constraints are: the first weight is between 8% and 27% of the total weight. The second weight is between 10% and 20%. The third weight is between 4% and 15%. The fourth weight is between 5% and 16%. The fifth weight less or equal to 10%. The sixth weight is less or equal to 25%. The total of the weight must be 100%. The volume constraints are: all of the volume must be positive and rounded. These are the meaning of the variables. These are the important equations. The calculation are using Excel formula.
uPort, your stock portfolio assistant.